appreciate how busy everyone is, so I don't want to keep those of you who are joining over Zoom waiting any longer. So I'll get started now. First of all, thank you very much for joining today. I really appreciate it. I do try to keep my webinars as short and precise as possible. It's not always possible depending on the subject, but this one shouldn't be too long. Alternatives is obviously a very big subject, and it's beyond the scope of one webinar to go into the detail of any one investment, really. But today we'll be looking at alternatives. What are they exactly? Who invests in them? And of course, we'll be looking at why they invest in them, and also taking a slightly deeper look into 2 or 3 specific types of alternative investing, which are very popular these days. Most importantly, though, what I'd like to share with you are some takeaway tips about what to look for when you're vetting and considering these types of assets for yourselves. Looking at some of the pros and cons, and hopefully giving you a bit of information that will help you when you're deciding if something is right for you or not. A little bit about me, for those of you who don't know me, and for those who are perhaps watching the recording later as well. I've been in the UAE for 23 years. I'm originally from the UK. I'm a Chartered Institute Securities Investments Qualified Financial Planner. But most importantly, I'm a husband, a father, and an avid sci-fi fan. So let's get to the meat and bones of it right away. What is alternative investing? Well, alternative investing, simply put, is anything that is not a listed stock or a listed bond or cash in a bank account. It's as simple as that. Some examples of that include things like property, private debt, tangible assets and collectibles. That can be anything from collectible baseball cards, unopened Lego boxes, to some forms of commodities, jewelry, luxury goods, fine watches, etc. Hedge funds, which are a combination of all of those things. Unlike regular funds, a hedge fund is allowed to do things like borrow and do all sorts of hedging techniques as well. They tend to be a lot more complex, a lot more expensive than regular funds. And of course, crypto now has become a bit of a buzz thing as well. It's taking its place, or at least some forms of crypto are in the investment world as an alternative. There are some key points to remember when you're thinking about alternatives and the nature of alternatives. And first and foremost is that they are less regulated in most jurisdictions, or sometimes don't have any regulation. Now, that doesn't mean automatically that it's bad or that it's a scam or something's wrong with it, but a lack of regulation does mean that you have to accept there could be higher risk if something goes wrong, and that you're less likely to receive compensation unless you're willing to go through the courts, which means, of course, you've got to look at the legal system where you're investing if protection is of great concern. But this is no different when you're investing in a lot of businesses as well. It's the same sort of category, and for a lot of real estate investors too. A lot of alternatives are illiquid, not all. Some of them are actually billed as being liquid. Crypto is one. In theory, you can buy and sell multiple times a day, but you can't buy and sell properties multiple times a day. Some collectibles can take months or even years to find a buyer. Fine art, for example, rarely goes on the market and is sold quickly. And that can be an issue if you need to get cash quickly. And traditionally, they tend to be aimed at the institutional, the ultra-wealthy, accredited, sophisticated investors. But over recent years, more and more alternatives have become more feasible and more accessible to what we would call retail investors, you, me, regular people that are not in a particular industry involved in finance and banking and all the rest of it as well. But they are considered or is viewed as more complicated and more high risk. So why do people invest in them? Well, first and foremost, it's a diversification play. Traditionally, the ultra wealthy in particular would make their wealth in business. They make their wealth in stocks. Today, that's quite common. The Warren Buffetts of the world, or sometimes real estate or inheritance. But then they decide that they can't have all their eggs in one basket, so they spread themselves out. We also see this a lot with people who are growing in wealth, and they're taking care of things like their long-term investments, their pension portfolios, inheritance for the kids, or causes they care about, but they want to put money in different parts of the world in different things. There's also a lot of prestige that's involved with some forms of alternatives because they're linked traditionally to high net worth investors or to more sophisticated investors. There's a bit of that as well. And so you can sometimes have bragging rights, let's be honest, when you're investing in these sorts of things. And of course, for some people, they're simply disillusioned with, or they don't really have a deep understanding of main markets. Particularly in the short term, stock markets, even major markets, can be a bit of a bumpy ride, and they can be disappointing. And so some people look elsewhere for places to put their money. So to sum them up, really, you could say the pros and cons of the pros and cons of alternatives generally is you've got a diversification play. You can put your eggs in different baskets. You do have the potential for very high returns. There's some data in some areas for some types of alternatives over certain time periods outperforming main markets. So that's obviously very attractive. They are illiquid, which can be a pro, because particularly if you're prone to emotion like most of us, because we're human, having illiquidity means that you're less likely to panic sell. You're more likely to hold on to something and let it run its course, depending on the type of asset you're looking at. And of course, some of them provide income streams, and particularly with loan notes, which I'll touch on later. And that's immensely attractive. Fixed income, particularly in difficult markets and high interest environments like we're in now, high interest rate environments, income streams can be extremely valuable. Plus, if you're retired as well, that's also very important. There's also cons. Of course, the risk. You do have to do more homework and more due diligence than you would if you're a passive investor. Regulation and transparency. I would say the regulation part isn't as important as the transparency, because if you're able to do your own due diligence on something and be satisfied with that, or get a third party who does that regularly to take care of that for you, then you can mitigate most of the issues that regulation is in place to protect. But complexity becomes part of that. I mean, to trade, for example, properly and be good at it, it's a lot of work. It's not as simple. I watch a couple of YouTube videos, read a book, I'm an expert. It can take months or years to get into that. And I've mentioned illiquid again, because that can also be a con. If you do need money quickly and you have to sell some forms of alternatives, you may find there's no secondary market, or you can't sell something until it's reached a particular term. That could be an issue. So when you're investing in some things, make sure you've got an exit plan, and that if you can't get out before the exit plan, that you've got backup assets somewhere to cover you for that time. I'd like to give you the first key takeaway, and this really doesn't just apply to alternatives. This applies to everything. In the industry, we say there are two forms of risk, and there's overlap between the two. But to break them down very broadly and simply, you've got market risk and systemic risk. Now, market risk is simply, I'll give you an example. I buy a property in a city where all the industry's closed down, there's no new investment, and everyone's leaving and moving elsewhere, like a Detroit suburb or something. All the car factories have closed. So I've taken market risk. I invest in Polaroid cameras in 2005 as digital really kicks off. That's a market risk. Not much you can do about that except learn the market, learn what you're getting into, and make sure you understand it. Then you've got systemic risk when it comes to investments. And this is really where I think people are more worried generally. Systemic risk includes things like poor regulation, poor management of a business or a company or an enterprise. It can include the risk of fraud and scams and all these sorts of things. Due diligence in both parts can mitigate both of these. And of course, with some alternatives, you'll never mitigate them entirely. And with really any investment, that's the case. But at least you can reduce them and get them to a point where you're comfortable and will sleep at night. And ultimately, that's what's important. So to dig into a couple of examples for you and to show you what's really out there in the market. And this isn't by any extent a comprehensive view of what's out there, but it gives you a broad idea of two particular types, which are very common, particularly with the internationally minded investor, the expat market, and people who are looking to diversify. Two big ones, and I've lumped these together: wine and whiskey. You may have seen claims on the internet, and some of them can be backed up with data, particularly with whiskey, but also with wine, that they can over certain times beat the main markets with the passive investments like the Dow Jones and all these ones as well. That, of course, comes with a lot of caveats. You've got to buy the right kind of wine or whiskey at the right time, hold on to it, and sell at the right time as well. But it can be done. So it's a very attractive asset. And of course, it's a very prestigious asset, probably one of the most prestigious. It's up there with luxury watches and luxury cars and all these sorts of things, and fine art. It's well known that it appreciates. Many wealthy people in many countries and many cultures have a history of investing in and holding large amounts of these fine wines and fine whiskies. But some things to be very wary about. Storage, particularly this applies particularly to whiskey, but also to wine. There's quite a bit of fraud in the industry. So you need to make sure that you know where it's being stored. When you're buying a barrel or a casket, check that carefully. Many countries, I mean, for Scotland, for example, the home of some of the finest whiskies, will actually have government bonded warehouses. Everything's got a serial number. They're checked and verified independently. And some countries don't have that level of protection. So you have to really know what you're doing. Taxation is also an issue. Most parts of the world, alcohol is a consumable, so it's a taxable consumable. And at least one point in the sale process, a tax will apply. So you need to know when you're going in, what's your tax situation, when are you paying for taxes, how much are you paying, etc. A very important fact, and something that surprises me, I've seen this with some providers of these investments they don't talk about, is insurance. You're holding a commodity potentially for years and years and years in a place that is quite vulnerable. They're not fireproof. These places, there's flammable liquids and wood. And so having the right kinds of insurance is quite critical. And some whiskey companies, for example, who specialize in investment, distillers, will actually have you, the investor, pay for the insurance. It's a very nominal fee, but it's fairly comprehensive: theft and fire, and even sometimes spoilage due to accidents as well. And I'd say probably as important of all as that is who's actually behind it. Are you rocking up to a distillery and being told by someone who has been doing it for 5 years that theirs is the best and it's going to double in value every 3 years? Or are you dealing with, an independent expert in wine and whiskey with a track record, with links to the best people in the industry, who's able to get you the best rates and give you an idea of what's actually happening and what the trends are like, and therefore what could potentially happen in the future? And then lastly, with wine and whiskey, there's something that take quite a lot of time to develop and mature. Whiskey especially. I mean, if you come in at the end of a cycle, you might be in for 5 years or so if you were to buy a barrel that's been there for a while. But if you're buying a fresh barrel that's just been made and is going into to be sort of mellowed and matured, you could be waiting 10 or 15 years. So you need to know what your exit strategy is. And so if you're looking to put money into that you think you might need in 3 years or 5 years, you need to look at a certain type as well. So to go into the next category of alternatives, loan notes, which have become very, very popular. And these have opened up a lot of investments to the general public, which have not readily been open before. A loan note, or I think in North America, they call them promissory notes, very simply put, is a private legal contract between a business and an investor or a group of investors. And that private contract states very simply that the investors will be giving the business money, and the business will return that money after a fixed period of time, which is typically 1 year, 2 years, up to 5 years I've seen. And they will also be paying interest. And the interest could be paid out on a monthly basis, quarterly, whenever, at the end of the 2 years. And they're all different. They've all got different structures. Loan notes typically fall into 3 categories of business, which tend to raise funds through these sorts of structures. The first one is property. Property is one of the easiest things to understand. It's one of the hardest things to invest in well, but understanding it's certainly very easy. We all know about it. Most of us live in houses. Most of us go to malls and to offices and things like that. We've got an instinctive understanding. With developers in property that work with, say, distressed sales, particularly, they need to be quite flush with cash to move quickly on deals. So they often raise funds on the side rather than using banks, because banks can take a long time. And as a quick example of that, if I were to be looking to get, I've got wind that a local office block is being sold by the owner because they're going through a divorce, or they can't keep up with the interest payments because, as we know, interest rates have gone up lately. And so I know there's a need for them to sell quickly to walk away. So the market rate could be $1 million, but I know if I call them, I might be able to get 800,000, maybe more, maybe less, something like that. So I'm already making 20%. But I need to be cash rich. I can't go to them, make an offer, then go to the bank, wait a week for the bank to send someone to evaluate it, come back another 2 or 3 weeks for the bank to do what it's doing, because by then somebody else has gone and got the deal. So this is why they raise money for things like that. And of course, when they do that, they're making money automatically on the purchase. Then it's up to them if they develop it, if they sell it on quickly, whatever they do. And so these kinds of loan notes are quite attractive because it's an easy to understand business proposition, providing you're working with the right companies. Some of them also work from the development side as well. Sometimes it's actually cheaper to raise money in the markets, even if you're paying out 7-8% in interest, than it is to go to banks. And there could be various reasons for that. Sometimes banks can be hard to deal with. Sometimes it's personal preference. There's many reasons for that. So that's property as a loan note, quite an interesting one. Typically, you'll find investments in this sector starting at around, in dollar terms, $25,000. They're very common in the UK and the US. And there are some companies that have been doing this successfully without any mispayments or failures for 20, 30, even 40 plus years. So there's a lot of good quality investments out there. in property. And the best thing about that, of course, is you can get involved in property without having to go through the pain of buying a property, finding a tenant, insuring it, all the rest of it. The second category of loan notes are in the litigation sector. This one is perhaps slightly more esoteric, sometimes harder to understand, but actually the business models are quite simple. The legal industry for a very long time has been expanding. More and more lawyers are offering cases on a no-win, no-fee basis. But of course, those lawyers still have to get paid to submit the case to courts. They have to get paid themselves. There are certain costs involved in any kind of litigation. So how on earth are these lawyers funding these cases? They're confident of winning, otherwise they wouldn't give you a no-fee, no-win basis. So what they do is they borrow money partly, at least in part, from specialist lenders, litigation funding lenders. And this is very common in the US and the UK. It's a growing industry all over the place. The cases tend to be very easy to understand cases, very clear-cut cases of mis-selling financial product services and insurance products, cases of fraud and things like that. Also sort of small accidents claims and stuff like that. The lawyers will typically front about 30 to 40% of the case fees themselves, and the lenders will fund the rest. The lenders, of course, have their criteria to make sure the cases are winnable, otherwise they're not going to be lending the money. On top of that, there are some lenders, particularly ones we work with, that also apply insurance to that. So they have to go and find a A-rated Lloyd's of London syndicated insurer that will also review the cases to make sure the cases are winnable. And so you've got multiple layers behind that. So they tend to be quite secure if it's done properly, more secure probably than most other investment assets. And they still tend to be quite lucrative, typically around the sort of 8% mark, sometimes more. So it's quite an interesting field. And from a diversification play, it doesn't get much different than funding litigation. I mean, it's so far away from the main markets. People are going to court to get justice in all market conditions. And the last one is trading, or sometimes it's known as arbitrage, which is I would say a little bit less popular because it comes with a lot more risks and it's quite hard to understand, but it's a growing sector as well. And essentially what you're doing with this is you're lending, particularly a trading company usually, which will be buying and selling to make a profit. Arbitrage is a form of trading, but it typically relies on multiple trades at much lower margins, but large volumes of them. And it's just about the price differences and buying in one market for one price, selling it at a slightly higher. Good traders can make a lot of money, and so they can offer good returns. But one thing good traders need is money. So they open up their business to the market once they've got a proven track record usually. And then it's up to you, the investor, if you're confident in that and you want to invest. I've seen returns offered in the range of 10% plus with these. They do look more risky because a lot of these trading companies don't have robust cash books. So it's important to look at those carefully and make sure you know what you're doing. But again, if you're looking at putting a small part of an already diversified portfolio, and it's money that perhaps you wouldn't be too worried about if it took a while to get back to you, it could be an interesting play. And it's a growing market as well. And there's different kinds of trading as well. There's more kind of stock trading and there's commodities trading. And there's algorithms behind this now as well. So it's becoming a bit more predictable in some cases. But when you're looking at any kind of loan note, you really want to make sure that you ask questions like, how are they making their money? There's someone who's offering you a loan note, whether this is an advisor or you've seen something online and replied to some, and you've got a salesman you're talking to, or you go directly to these companies, perhaps you've come across them. You need to ask how they're making the money. And if they can't explain that in a very simple way that's clear and easy to understand, that's potentially a red flag. Warren Buffett always says that he's never invested in anything he doesn't understand. He knows a lot more about money than most of us, and I think it's a good yardstick. Complexity doesn't always mean better, and usually it means more risk that you're for no reason whatsoever. You've got to, of course, look at who's behind the investment. Look at their track record. Are you talking to people who are 2 years in the market and think they know what they're doing, or are you talking to a property developer with 40 years market experience, headed by one of the largest private landlords in that particular country? There's quite a bit of difference there. Then you've got to look at protections. Now, protections vary from loan note to loan note, and you may be happy with no protection at all, or you may want some insurance or debenture over the assets, which is charge if a company were to go bust. You've got legal rights to break up the assets and sell them through a trustee and get your money back. So that's something to look at as well. Make sure that they've got paperwork to prove the protections exist, because it's very easy to weave a a nice story and get some paperwork together, but it's not accurate. And of course, with any investment, you need to think about your own personal biases. Are they blinding you to see something positive or negatively? Biases can come from historical experience. They can come from how we were raised. Somebody raised in a wealthy family during a recession who didn't even notice a recession is going to have a very different view of money to somebody who perhaps is from a poorer family, or from a family that lost all their money, or that they've had to struggle their whole life, or whatever it may be. So you need to be conscious of those things, and don't let them override what could be a potentially good opportunity, or at the same time, don't allow them to carry you into something that's actually got dozens of red flags. One of the things I like doing, and if you read my blog, you'll notice I do this a bit, and if you know me personally as well, is I like to do a bit of myth busting. I like to look at what's going on with all the misinformation in the markets these days, and sort of set the record straight where I can. And so I always try to add this when I'm doing any kind of webinar or presentation. And the first thing that I like to drive home, whether you're only investing in alternatives, or you're a mainstream investor, or you're actually not sure, you're just starting out in your investment journey and wondering, what step should I take first, is think about high returns not being as important as consistently good returns. And I'll give you a quick example of this, which I've used before. One of the most successful Wall Street investors of all time was a chap called John Simons. He was making somewhere in the range of 66% per annum from around 1998 until 2018. He's a billionaire, worth about 20 or 30 billion, and just blew everyone out the water. To consistently do that for 20 years in a row is really not heard of. People can make more than that in the short term, but they can also lose a lot more than that. And this guy just steamrolled through. He was one of the early proponents of using algorithms and science and evidence-based investing, but not many people have heard of him. And he's worth about only 20 to 30 billion. But if I said to you, have you heard of Warren Buffett? Hands will go up. Everyone knows who Warren Buffett is. Buffett's worth about 100, 120 billion. I don't know what his exact figures are today, but his average batting average is only, and I say only, 22% per annum. So how on earth does somebody who's making 22% per annum knock out of the ballpark somebody who's making 66? And the answer to that is consistency. Warren Buffett has done very simple things for a very, very long time. He started investing early and he's never stopped. He tries to avoid doing dumb stuff rather than being clever. And as a result, he makes a lot of money. And when he gets his dividends, he reinvests those dividends and makes even more money. Something else to keep in mind, even if you are a fan of alternatives, is that historically, if you look at markets like the Dow Jones, the S&P, if you take any 5 or 10 year period, you're likely to see returns of around 10% net. Sometimes more, sometimes less. And there are a few periods where it was a bit rough and not as good as that. But the markets generally are quite efficient, and over time they do work. And that's going through recessions, that's going through wars, that's going through financial crises, changes in government, high debt, low debt, all the rest of it. Which is why, coming on to the third point, passive investing is probably the most common type of investing that's used globally. Most people are saving long-term for pensions, retirement, they're saving for their children's education and things like that. And so they don't always have time to go and study markets and learn all about it. So they outsource that either to a fund manager or increasingly to an exchange traded fund, which does have a manager, but it's more automated and much lower in cost and fees. And they just take whatever the market gives them and they reinvest any profits they make. Now, for beginning investors, passive investment tends to be the most ideal place to start, because we all have to really think about, our retirement. We're going to get old one day. We're not going to work. If we've got children, we've got to think about giving them something when they grow up, and we've got to sort of cover the basics. So even if you're building a business, you're an entrepreneur, you're big on alternatives and are going to go into that in a big way, it's important to keep in mind that you should still have a small passive portfolio somewhere doing something in the background. And this is incidentally something that even advocates of specific asset classes have admitted to doing. Robert Kiyosaki, in an interview, I think it was last year, stated he does have a stock portfolio. It's not as big as his property portfolio, but he does have one. And he's got investments directly into businesses as well. And he's covered his bases. It's not just property, but that, of course, is how he's made his fortune. And that, in a nutshell, really is it. I thank you for coming today, and thank you for watching the recording, for those of you who are going to be doing that or looking on other platforms. And I'd like to leave my contact details here. You can scan the QR code, and that will give you my digital business card. And at the bottom of that, if you scroll down, you'll see a meeting link, which you can book on Calendly if you'd like to have a Zoom call, a one-to-one, no obligation. Always happy to have a chat. That's linked to my diary, so we'll match up very easily. And below that is my blog link. Now, I blog every week, typically a 3 to 5 minute read. I do a variety of subjects broadly under the category of international investing. It's a globalized economy, and people need to think a bit more about the world at large rather than just investing locally as well. They've got to have their eggs in different baskets. So thank you very much for that.